Once upon a time, in a peaceful pond, a frog had a big idea to start a fly-catching business. Frogs love eating flies, but catching them has always been a hassle. If only there was a way to make fly catching easier and more profitable. Frog realized that, with the right investment, this could become a booming business. Robbing a bank wasn't the best way to fund it, so the frog turned to other wealthy frogs in the pond for help. "I have a great business idea," said the frog. "Help me, and in exchange, I'll give you a piece of business." Wealthy frogs were intrigued. They saw potential for big profits. The frog needed money, and rich frogs wanted a share of business. This is when Frog learned about stocks. The concept of stocks. When you buy stock, you're buying a piece of a business. So when rich frogs gave Frog money, they didn't just give it away. They bought stock in the fly-catching business, which made them part owners. The more money they gave, the bigger the share of the business they owned. Think of stocks as ownership pieces of the fly-catching business. If a frog buys a piece of equipment to catch flies, they own that equipment. Similarly, when frog investors buy stock, they own a part of the business. The more stock they buy, the bigger their portion of the fly business. Now, with this new money, the frog could grow the business. Instead of wasting it on a fancy Lamborghini, the frog reinvested in better fly-catching equipment, more flies, and more land to catch them. The goal? Grow the business, earn more profits, and increase the value of company stocks. Dividends. Profits from flies. Here's the fun part. As the fly-catching business grew and earned more money, the frog decided to share profits with the investors. This is called dividends. Every time a business made a profit from catching flies, investors received a portion of it. For example, let's say the frog made 100 lily pads in profit from catching flies in 1 month. Instead of keeping it all, the frog gave a portion to the investors. The richer the business got, the bigger the profits, and the bigger the dividends for investors. This is how everyone wins. Investors earn money while the frog's business keeps growing. Stocks versus shares. So what's the difference between stocks and shares? Frogs often use the terms interchangeably, but they mean slightly different things. If stock represents the whole fly-catching business, then shares are like the individual pieces of it. For example, imagine the frog owns 100 shares in the business. That means they own a small piece. But if they own 1,000 shares, they own a much bigger chunk. The more shares you buy, the more of the business you own. Stocks equal the whole business. Shares equal the individual slices of that business. It's like dividing up a pile of flies. Each fly is a share.
Types of stocks. Not all flies are the same, and neither are stocks. Some flies are easier to catch, some are harder. Similarly, some stocks come from big established businesses that grow slowly and steadily. These are called blue chip stocks. They're considered safer because they come from companies that are less likely to fail. Then there are smaller, newer businesses still figuring things out. These are known as penny stocks. Penny stocks are often cheaper, but much more volatile. They might offer huge rewards, but they also come with a much higher risk of loss. So, a smart frog investor has to weigh the potential gains against the risks. The stock market. Where do frogs buy and sell their stock? Welcome to the stock market, a giant pond where all the frogs gather to trade shares of businesses. Just like a pond full of fish, the stock market is full of opportunities. The frog stock market is where all the action happens. Frogs trading pieces of the fly-catching business with one another. The stock market is always changing. When prices rise, it's called a bull market. Frogs are happy, profits are rolling in, and everyone's hopping with excitement. When prices fall, it's called a bear market. Frogs get grumpy. The future looks uncertain, and there's less hopping around. But just like seasons, markets change, so frogs must be prepared for both. The stock stock fund. Not all frogs want to pick individual stocks. Some prefer to invest in funds, which are like baskets full of different stocks. For example, the S&P 500 is a fund that includes the 500 largest frog businesses. Instead of investing in just one business, a frog can spread their investment across many, reducing the overall risk. If one business struggles, others in the basket might balance it out. Most frogs see stock funds as smart investments because they offer diversity and generally lower risk. But nothing is guaranteed. Sometimes a politician frog makes a splash and the whole pond ripples with instability. Hedge funds. Then there are hedge funds for super rich frogs who like to take big risks. A hedge fund is a collection of high-risk investments that could bring big rewards.
These are not for the average frog. Only the wealthiest frogs can afford to take such chances because the risk of losing all their lily pads is much higher. Why stock prices change? Stock prices are always moving. Why? Because of supply and demand. If more frogs want a piece of the fly-catching business, prices rise. If the business starts catching more flies, that's good news. Prices go up. But if the business struggles, maybe the flies get scarce or catching them becomes harder, then the stock price drops. Even news can affect the price. For example, if a frog discovers a new way to catch flies, investors might get excited and push prices up. This is something crucial. Psychology matters. Sometimes frogs get caught up in the excitement. They buy stock just because others are buying. If all the frogs rush in, prices might rise simply from hype. This is called market sentiment. On the flip side, bad news can spark fear. Frogs might panic and sell, even if the business hasn't changed. Prices drop. But were those decisions rational? Not always. Successful frogs know to stay calm, ignore the noise, and make informed choices. Economic factors affecting stock prices. Economic conditions also impact stock prices. If there's a drought and few flies are around, prices might rise due to scarcity. If there's a flood and flies are harder to catch, profits might fall and so will prices. Other forces like inflation, interest rates, or new laws can also affect the entire pond. Smart frogs keep an eye on the weather and the economy. Understanding stocks and how investing works helps frogs make better decisions about their lily pads and future. The stock market is a place to share in the rewards of business success, but it also carries risk. Not every investment will work out, but when they do, the rewards can be great. Just remember, investing is a long-term game. It's not about getting rich overnight. It's about learning the business, making smart choices, and riding the ups and downs. And most importantly, this is not financial advice. Don't sue the frog.